Just as we strive for physical fitness, achieving wealth in the stock market requires investing in financially robust stocks or companies. But how can we determine a stock's financial fitness? Indeed, there's a way. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. You can check whether a company is financially sound by looking at its financial statements. An annual financial statement gives you a comprehensive report of company's activities during the preceding year. It includes 3 important statements: cash flow statement, profit and loss statement, and the balance sheet. We have already created a video on decoding the balance sheet earlier. Today's video is going to be all about how to read and analyze a profit and loss statement of a company. So let's get started. Profit and loss statement is also known as the income statement. So just like when you prepare budget for the month, you write down your household's income in one column and expenses on the other side. Profit and the loss statement is also a kind of budget statement for the company. It is a kind of ledger where all the incomes of the company for the period are listed and then all the expenses are deducted from them to arrive at the profit the company is making. Now, for an investor, it is important to know what kind of profit the company is making. Ultimately, the stock price follows profit growth of the company. A company not making good profits is unlikely to do well on the exchange as well. P&L statement is published every quarter as well as yearly. Just for your reference, you can see the profit and loss statement of Infosys for the quarter ending September 2023 on your screen. Now let's understand the items in the profit and loss statement one by one. First is revenue. Now revenue means income. It is the income that a company gets from sales of goods and services it produces, also known as income from operations of the company. Now Infosys is a software company, so its revenue comes from the services it offers to its client. Comparing revenue generated by Infosys vis-a-vis its peers, so Infosys generated the second highest revenue among its peers after TCS. Another way of looking at the revenue is to compare it with the previous year revenues of the same company. Now look at the table on your screens. As far as the revenue is growing, it's a good sign. And by how much it is growing compared to the historical numbers and peers can be done by looking at the P&L account of companies. Now one important thing here. The stock names that we are using in the video are not our recommendations. We have used them only for illustration purposes. Next, after revenue comes other income. Now it is simply the income that the company earns from its investments or interest earned from deposits, etc. These incomes are not from the business of the company. At times, some companies do have significant other incomes. But an important thing to look here is that if the major part of a company's revenue comes from other income and not from income from its operations, it is a cause of concern. Now let's see what the other income of Infosys tells us. So for Infosys, other income has increased over the years. Coming to total income. Revenue plus other income gives the total income of the company. Higher the total income, the better it is. Now let's move to the expense part. Expenses of the company are basically the cost of running a business. After deducting these expenses, one arrives at the profit or earnings of the company. These expenses majorly include cost of producing goods and services, wages, rent, marketing and administration expenses, interest expenses, depreciation. Now, while most of these expenses are self-explanatory, interest expenses are the interest paid by the company for any loan taken. While on the other hand, depreciation is basically the reduction in the value of the assets of the company due to normal wear and tear. Charging depreciation allows the company to cover the cost of the asset over the lifespan of the asset. These expenses may differ from one company to another, as a manufacturing company may have higher production cost, while software company may have higher employees cost. It is always better to have lower expenses, but again, you can't say anything on a standalone basis. You have to compare it with the previous years as well as look at in conjunction with the revenue. If both the revenue and expenses are growing, it's a good sign. Now, revenue minus expenses gives you profit before taxes, means the taxes are yet to be deducted from the profits. So next on the list are taxes. Companies need to pay taxes to the government on the profits made. These are calculated on profits before taxes. After deducting the taxes, you get profit after tax. Now on your screen is the P&L account of Infosys. You can see profit for the period is nothing but profit after taxes, which is calculated as profit before taxes minus taxes. Now, in case the expenses are more than the income, then it will result in losses for the company. The PAT of the company, that is profit after taxes, is an indicator of the company's financial performance and profitability. It reflects the ability of a company to generate surpluses after accounting for all the expenses and taxes. Stakeholders closely monitor PAT to evaluate the company's effectiveness in generating sustainable returns. Now, once you have understood the different components in the P&L account, let's look at how to use them to analyze a stock's financial fitness. We'll cover two most important ratios to show you how the P&L data can be used to analyze a stock: PAT margins and return on equity. Now, PAT margin is the financial ratio that tells you the profit a company earns on each rupee of revenue or sales. The formula is on your screen. Increasing PAT margins and PAT margins higher than peers is a good sign. Look at your screens. Infosys profit margins have dropped in the last 2 years. It may not be a good sign, but again, one should also compare them with peers. Plus, it could be cyclical, so you need to know the reason and also keep an eye if it continues to go down for a few years. Next is return on equity. It shows how much profit a company is making as a percentage of shareholders' equity. It basically tells how efficiently a company is using the money contributed by shareholders. Higher the ROE, the better it is. Infosys ROE has gone up over time, which is a good sign. Now, there are different ratios you can calculate using the data in the profit and loss statement of a company to gauge how sound the business is, which can help you with your stock picking. And it's a wrap. Hope you liked the video. Don't forget to like and subscribe. Also press the bell icon to not miss any video from us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.